CME Group is launching Micro E-mini futures contracts. Discover how a smaller Micro E-mini futures contract opens the world to greater trading possibilities.
Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Good to be here, Jeff.
Well, it's interesting. We are in the heart of earnings season. About 130 names in the S&P 500 are reporting this week. We still have trade negotiations going on, but what is your focus this week?
Well, it's the revenue line. We were underperforming a little bit on the revenue side of things right now with a small portion of the S&P. Most are beating an EPS, but not all are killing that revenue number.
Well, as earnings season is front and center, those trade negotiations, we saw a little bit of a flip-flopping from the administration out of China. Are you concerned at all about those ongoing trade negotiations?
I think they're taking a little bit of a back seat with earnings starting to be in full swing, especially this week with some of these key names reporting.
No, that's a great point. You ready for this first lightning round, Bob?
I am ready.
Let's do it. Iran waivers expire. Well, we really saw this splash into crude oil. We saw a surge, a pop higher in crude oil, above $65, now above $66. What does this mean, these Iran waivers expiring?
Well, the 8 countries that got exemptions, 7 of those are in the top 10 that purchased from Iran. So this first pop was definitely about the actual news, caught the market a little bit by surprise. The second pop is about Iran's threat to close the Straits of Hormuz in retaliation.
So that's really interesting. We're seeing all this in the face of a strengthening dollar. So what type of trade exam would you utilize to embrace this geopolitical tension?
Well, since I don't believe they'll actually succeed in closing the Straits, I'm selling the week 1 May 70-73 call spread in crude oil. This means I'm selling the 70 call, receiving about $200, and then buying the 73 call for about $60. This call spread allows an investor to collect about $140 per contract.
That's really interesting. The expiration on this is May 3rd, so you're about 2 weeks out. And the June futures, when this trade example was priced, was at 66.44. And the at-the-money vol, always important to watch that at-the-money vol to understand emotion and the option premium that people are willing to pay in this market price was actually 25.16, Bob.
Yeah, this example plays on the idea that crude oil is probably properly priced. If they succeed in closing the Straits, however, it should pop higher than that outer strike.
Yeah, I think we'd see 73 and much, much higher if that actually came in to fruition, for sure.
Totally agree.
All right, I like that, Bob. And please remember, these are trade examples, not trade recommendations. Let's move into the second lightning round.
Let's do it.
Earnings season strength. Well, we talked about it. We have certainly seen a lowered bar. Year over year, we're seeing about a 4% decrease in these earnings, but nonetheless, we are seeing financials. We are seeing this week a plethora of names come out and beat those expectations, but more importantly, I think it's the guidance, Bob. We have some positive guidance.
Yeah, we did. And we had Lockheed Martin was one example where they raised the full year forward guidance. Again, very much focused on that revenue number. A lot of companies are beating, not all of them though.
No, they're not. And that's why I want to get into the fact that I'm embracing and approaching this market due to the fact that earnings season, this is a nice way to see the S&P 500 stay above 2,900. But in the event we do see a little bit of a pullback, I want to utilize options on futures to express this view. So I'm buying the May week 2 2,800, 2,750 put spread in the E-mini S&P 500. I'm buying that 2,800 put for $200, and I'm selling that 2,750 put, 50 handles lower, for about $125. This is a pretty inexpensive risk mitigation tool, Bob.
Yeah, I think that's the key phrase. It's a very low-cost way of kind of getting a little bit of premium in if we get that dip, and then you can get involved again if the market calls for that.
And remember, this trade expires May 10th, and the June E-mini S&P 500, the underlying contract, was trading at 29.31, and the at-the-money vol is 9.71. Pretty decreased, suppressed type of volatility when you approach a trade example like this, Bob.
Yeah, and again, that's why it's so cheap to get into. It's a limited risk way to play a potential reversal of this very strong market.
That's right, cost an investor $75. Well, let's also talk about, I want micros. We talk about micros, and what does that mean, Bob? Well, May 6th, we're going to see the S&P 500, the NASDAQ, the Russell 2000, the Dow Jones offer the micro contract. That's 1/10 the size and the margin of the notional value of the futures contract. Really excited about this, Bob. It's going to be an exciting launch on May 6th.
Yeah, I'm very excited to actually put this contract into practice in my own trading so I can kind of dial down a minute detail on some of the options and some of the longer and shorter futures positions.
I think you bring up a great point. We talk about futures being the power tool and understanding how to use those power tools. I think these micros will be more of the precision tool. Will really allow you to dial it in, correct?
Yeah, I love that example. Again, getting in and out of trades, being able to scale with the smaller contract, very important.
Great stuff, Bob. Thanks as always for coming on Striking Options. We want to thank you for coming on to Striking Options. Please tune in every week as we will continue to strike options.